Okay, this video is on Fibonacci retracements, and it's a test video. What I want to do is come over here. So right here on, looks like this, or October 11th, 2007 was the previous all-time high prior to the real estate crisis and the crash. And in October 2007, the market was at 1,576 on the S&P 500 and hit a low of 666. Wow. Those are lucky numbers. On March 5th, 2009. So in a little over October to March, what is that? About 6 months, the S&P 500 lost was almost 900 points. That's quite a bit. Anyways, so if you see these red lines here, these are the Fibonacci retracements. So I used the previous all-time high prior to the real estate crash, and I used the low following the crash before this historic bull run of 666.79. And I put in a Fibonacci retracement. And you'll notice at about the 100, I'll go ahead and highlight this. At about the 100% retracement, which happened right around, looks like, what is that? March of 2013, the market started to retrace the entire move upward of the previous high. And it looks like this is a weekly chart, by the way. Looks like we spent about 1, 2, 3, 4, 5, 6, 7. Okay, a good solid 7 weeks, almost 2 months before we decided to break out. And even after we did break out, we came back and retested it short time thereafter, probably within 3 months we retested it. All right, so that's, let's see, 2009. So it took 4 years to retrace the all-time high, or I'm saying 4 years. All right, so let's go ahead and move forward in time. So then you got to start wondering, okay, we broke through the 100% retracement. What is the next move? And that is what they call the golden ratio, 161.8. And we hit that, the 21, and that comes out to 2138 on the S&P 500. And we began to hit that probably right around, looks like February of 2016. And we just kind of hung all in there, and we could never really quite break through it. And let's see. What is that? That looks like July 20th of 2015. Okay, we weren't able to break through it. Okay, that's over here, right? And so then we started drawing back. These lines here, the green line here, that's the 200, I guess in this 200 day moving average, okay, or 200, I don't think that's a 200 week moving average. The red line up above is the 20, and the yellow is the 50. Those are the three moving average lines that I like to use. Try not to make it too complicated. The box below is the implied volatility. Obviously, when the market's crashing, implied volatility goes up. And down below is basically a momentum indicator, the MACD, moving average, convergence, divergence indicator. All right, so we hit that golden ratio in the Fibonacci. And if you ever want to learn more about that, just Google it, and you'll find out that in nature and so forth, there's a whole bunch of things with that 161.8% or the 161.8 ratio in nature. So it looks like so right around February of 2015, we hit that 161.8, and it takes us a good up until looks like July. So looks like it takes almost 5 months. Okay, let's go ahead and come on in a little bit here. Okay, so here back in February, we're testing the 161, and we must have spent what, a good solid quite a bit, almost 6 months of not really ever breaking through that, and then obviously drawing back down, and then finally it looks like in July we break through it, but we just kind of still hang around that 161.8 before the bull market resumes. All right, so then you got to wonder, what's your next point? So the next point is a 261.8, and that's kind of where we're at right now. We never quite reached it. The 261.8 comes out to 3047.34, and we never quite reached it. The high we've reached so far is the 2940, and so that's where we're at. We hit that, and then we drew back all the way back down to the 200-day simple moving average. Nice little bounce here. All right, so that's a weekly chart. If we look at it from a daily chart, all right, let's look at the most recent. Okay, so we hit an all-time high. We came back. We drew way under the 200-day moving average. All right, looks like we try to we retested the 200-day moving average once, twice, 3 times. Couldn't resume the bull trend, and then we fell way below it. And now it looks like just as of today, which is February 6, 2019, we are retesting that 200-day moving average. So that's kind of what's going on here right now. Looks like we might have like a intermediary head and shoulders bottom. This may, we'll see what happens in the next couple of days as far as whether or not the market will try to break out. Personally, I think we'll probably test somewhere on this 2800 level and then withdraw just a little bit. But as far as MACD and so forth, you know, it looks good. There's no crossovers as far as towards the downside. And if we looked at implied volatility is also starting to really come back down to where we were, or not quite there, but starting to get there. So obviously a lot of movement going on there. So in the next video, we'll talk a little bit about what types of trades we could trade in this type of environment and so forth.